Welcome back to the STR Loophole Show. I'm Arda Bircan and I'm with Randall Weaver, one of our CPA partners today. Randall is one of the top CPAs in the country when it comes to tax optimized RSU planning and real estate investing. Today, we are going to talk about the problem every Broadcom employee knows but won't say out loud. If you're a Broadcom or former VMware employee with RSUs that are vesting 200K or more quarterly, this episode is for you. I have spent time talking to a number of people inside Broadcom recently, and the same thing keeps coming up. RSUs vest every quarter. Broadcom withholds a significant chunk at each vest, sometimes up to 50% above the certain income thresholds. So the vests themselves aren't a surprise. But there is still a real tax bill sitting at year end. And when I ask people what their plan is for it, most of them don't have one. The default is hold the stock. The belief inside Broadcom is that you retire on that stock. The AI story is real. The company is diversified. People have conviction. I'm not here to argue with any of that. What I'm going to show you is a strategy, completely legal, used by high-income earners across the country that takes the cash your RSUs are already generating and puts it to work in a real estate asset that offsets your tax bill. You're not selling your long-term Broadcom position. The capital comes from older vested shares sitting in your Fidelity account, the shares from your prior quarters that are just idle, not working for you. I'll set the picture, then our CPA partner is going to open the spreadsheet and walk you through exactly what the math looks like. Let's get into it. Randall, welcome.
Thank you, Arda. Good to be here, and look forward to looking at some real numbers that have real impact. So these RSUs, the restricted stock, that is vesting. Obviously, there's different levels of employees, different levels of vesting. We're just going to look at, a simple, fairly straightforward example. The facts and circumstances for individuals may be a little bit different, but let me just pull it up, and we have two examples. All right, so we're going to look at two scenarios. We are going to, and I'll just move my mouse so we can understand what we're looking at. So we're looking at a quarterly vest, and let's just stick with scenario one, quarterly vest of $500,000. So for the year, that's going to be $2 million. And I added an assumption of, okay, you probably have some other income. You might have dividends, interest, capital gains. So I just put a figure to that. And then you have a base salary. Now, line 10 is not taking into account the fact that you might have some deductions. Obviously, you get a standard deduction. So let's keep it simple, though, that we are keeping big picture here. So you definitely are going to be in the top tax bracket. And what that means is a lot of what you receive will be taxed at 37%. And in California, if you're a California resident, the top rate is 12.3. As you can see, it says 13.3, but people in the top bracket get hit with an additional 1% potentially. So we're just assuming that you're going to be paying that, as well as a Medicare surtax that applies, and there's no cap on that, meaning you could have 100 million and you would be taxed on that. So one caveat, because I am an accountant, Arda, is these numbers do not take into account the fact that, and this is maybe too small to see, but in California, just like the federal government, the IRS, we have a progressive tax system. So you will get the benefits of the lower tax brackets. So the top tax bracket in California starts at 1 million. That means that some of the RSUs will go through those lower tax brackets. Same with the IRS. You have the top tax bracket's actually lower for the IRS. It's 625. And we are assuming single in this scenario, just to be clear, because married filing separate or married filing jointly is different numbers. But so again, these tax rates that we're putting here are just making it simplistic for everybody. So we're looking at 51.2% and basically saying, hey, what is the tax impact for the vesting that's going to happen in 2026? And by the way, these are actually 2025. I didn't pull up 2026, so the brackets are going to be a little different. But your tax bill is going to potentially be around $1 million. And that basically means, hey, after the 2 million, how much of that can I keep? One thing we need to point out, Arda, is that obviously these RSUs aren't actual deposits into people's bank accounts, right? So I think one of the struggles that everybody probably is trying to think through is, number one, am I going to take less stock to help pay for the money that's being taxed on my account? Am I going to, pay for some of it personally, which then means I take, lose some cash? But at the end of the day, these do have real impact. And obviously the post benefit of the RSU is that if you hold it and it gains, Broadcom stock gains, and we assume it probably will, then you're going to have capital gain treatment on whatever the appreciation is in that stock. And I forget if you mentioned that, but I think one of the things to consider is, okay, you probably have some RSUs from previous years that are available to you that have vested that you're able to take out of your account. And so that is what Arda and I would say would be the planning opportunity to think about the short-term, rental. The total annual tax bill for somebody that's having 500,000 vest a quarter is going to be around $1 million. Somebody that is vesting 250,000 a quarter, might be half of that roughly. And then, the impact of doing that year after year would mean after 3 years, you would be handing over to California and the federal government around 3 million in taxes, or around, for the second scenario, around 1.5 million. So this is where the short-term rental strategy, the loophole, comes into play. And we do have another spreadsheet to share. We want to share another spreadsheet with you that shows the short-term rental loophole strategy and kind of the impact of that. But before we get into that, the thing that's really important to understand is there is buckets basically of income that the IRS allows, and they put walls kind of between them. So I think of it in 3 buckets. I think of your active income, that would be your W-2. You have your passive income, that would be investments in syndications, if you've ever done that as a limited partner, and rental properties. And then you have your portfolio bucket, which would be capital gains, dividends, interest. those are great. It's great to have income in all three buckets. We're not saying you shouldn't, but the strategy here is to try to move what normally is passive rental. We're trying to move it into the active bucket. And how we do that is how the code is written, how the IRS code is written, is that there is this, and it is a loophole, right? But it's not meant to be, it's not meant to sound like something that's illegal. It's very legal. And what it is if you have a rental period on average of less than 7 or less days throughout the year, and you're renting obviously to a bunch of different tenants, and you have at least 100 hours in the activity of renting that rental property and managing it, then you get that bucket, that passive, what is a passive bucket, and you are able to move it to your active income. And why is that important? Why is that important is because you have potentially 2 million in RSUs vesting. So whatever you just got in your rental column, and we'll get to depreciation in a moment, you now just moved over to this other column. And there's some other, we could dive deeper into it maybe in another episode of what you need to do to make sure you're active. But the concept is it is separate until you're able to claim the STR loophole strategy. And that's something that Arda and his team and the team at Trout would be able to help you with and consult you with into how to be compliant. So I am now going to share my screen just to get to some numbers. So what we're talking about, because one of the questions that comes up is, oh, well, I have all these taxes I'm paying. That's taking most of my cash because I want to retain this stock because I think it's going to appreciate. What do I really need to do? How much do I really need? And, typically on investment property, you're going to need maybe 20% down or so. And Arda could definitely help you decide what level, where to pull the cash from. But the rest could be financed. So it's not like you need to come up with the cash for all of it. So that's an important point to remember. And then the second point to remember is on the back end, you are going to get some tax savings in the form of a tax refund, or in the form of maybe you tell your employer, hey, I don't want to withhold quite as much because I know I don't need to. So we're just going to look at an example. We'll try to keep it simple, and just know that obviously if the short-term rental purchase price is triple, in this example it's 900,000, but if it's several $1 million, obviously that's going to have even a greater impact on being able to offset the RSUs that are coming. We're going with 200,000 that cash that you would need at close, and the purchase price is 900,000. And then we're going to make the assumption that cash on cash, you would actually have $65,000 in your pocket after a year of having this property. And then we're going to make the assumption that you're going to have depreciation of around 231,000. Again, facts and circumstances, everybody's situation's different when it comes to depreciation, but let's talk about depreciation. So the IRS really wants to incentivize people to buy in the United States because they, it's good for the economy. It's good for people to own property, and especially they want businesses to be able to invest. So they want to give you a deduction for it. So even though properties generally appreciate, the IRS is giving you the ability to have a tax deduction annually based on 39 years. If it's a short-term rental, it's 39 years. obviously that's pretty slow depreciation. So what we always recommend with people that do the short-term rental purchases is to do a cost seg study. And what a cost seg study does, and it's not done by CPAs typically, it should be done by an engineer, structural engineer, and they give a beautiful report that supports their analysis. But basically, they look at the building and they break it down into different categories, and those categories are shorter depreciation lives. And the benefit of that is it moves it out of the 39-year depreciation life and it moves it to something shorter. And right now, because of the tax law change that just happened a year ago, the depreciation benefit is 100%. So why it's 231,000 is because it's called bonus depreciation. Bonus depreciation is now 100%. It was going to be only 40% last year, 2025. So it was going down, but they restored it and now it's back up to 100. So long story short, it's not like you're doing this game where you're getting additional deductions. It's that you're looking and saying, look, this is the present value of money. Inflation's constantly happening, so I might as well get a benefit today versus waiting 39 years to get a benefit. And so why not get it today? And why not do this next year then as well? So let's get down to the actual numbers then of what, because the depreciation doesn't mean tax savings, right? That means, hey, on my tax return, basically what I'm going to do, remember back to the comparison of the buckets, the active, the passive, and the portfolio. What you're doing is you're saying, hey, in my rental bucket, obviously you have income and you have utilities and you have real estate taxes and you have mortgage interest, you have depreciation. And we're just assuming that all kind of nets out and the depreciation is really what's going to create a tax loss. And we're just keeping it simple. And we're saying, look, that tax loss is going to be 230,000. This number here, 230,777. So again, as a reminder, you had a down payment, you needed cash for that. So that out of the 200,000 that you put as a down payment, you also got the benefit of renting this property, and we're assuming 65,000 because Arda and his team are going to identify a good property. It's really important to note that tax savings are important, but if you buy a terrible property, you're going to regret it fairly quickly. So it's very critical that you buy a good property that is rentable. And so your savings from depreciation is your tax savings, federal tax savings. And there would be some state savings as well, but we're just going to focus on federal, would be 85,000. So you're going to get 65,000 in, income from the rental above your expenses, plus 85,000 in a federal refund. So you're going to get a net cash benefit of 150,000 just from 1 year, and have an asset that is outside of what you're building up with your RSUs and your Fidelity account, which is great. And if I could just quickly point something out that's pretty important that I haven't said is that land is not depreciable. So there are certain states, California being one of them, that the land allocation or the land portion of the property's value is high. So what does that mean? It means your benefit on depreciation is going to be less because the building value is less. So one thing to optimize with Arda and his team is trying to identify and know before you pull the trigger that, oh, by the way, the land assessment for this property is 50%. Well, now you only have half of that property available for the cost seg study, which makes a huge difference. So, and I'm sure Arda has seen it across the country. It can vary greatly, whether you're by the coast, what state you're in, what those land assessed values are. Sometimes I just had one recently. I'm located in Pennsylvania. I had one recently in Pennsylvania that was like 7% land value. And I just kind of laughed at it because, the week before that, I had seen one that was like 60 or 70% land value. So it can vary greatly. So if we just take this and we say, hey, that was great, can we run this back and do it again? In year 2, you identify another good property. Now all of a sudden you have 2 properties that are cash flowing approximately $65,000 a year. Now you have $130,000 in cash building up, and the depreciation rules are until Congress changes them, they're going to be the same for the next few years. And so you're going to look at that. Obviously we're keeping it simple. We're saying, hey, you bought another $900,000 property. You're able to deduct $231,000 in year 1. Hey, I just saved another $85,000. And now we're talking about, we're having $130,000 plus $85,000. So now all of a sudden we have $250,000. And then we're gonna, can you run it back a third year? Well, the third year, we're just gonna add another $65,000 because now we have a third property. We again are able to do a cost seg study, save another $85,000. So now we're talking about $280,000 with 3 cash flowing properties on average, $65,000 a year plus the tax savings. And if you look down at the bottom, so you've saved over a 3-year time period, you saved a total of $256,000. You have rental income of and the cash flow of $390,000 for a total of close to $650,000 of wealth created outside of your Fidelity account. So it really was only year 1 probably that you had to pull maybe some of your old RSUs that were you were able to sell to get that seed money for your first rental property. If I could quickly, because we're looking at $650,000 of savings, I'm just going to go back quickly to the other spreadsheet with no strategy. So 650 you could have, obviously that's less the initial seed money, versus doing nothing, letting the tax, be withheld from the RSUs and have an impact of 3 million. With the strategy, with the plan, will there still be a tax bill and an impact for RSUs? Absolutely, unless you get a very large property to offset, and that's always a possibility that you could get a very large one. But I would much rather have, not pay the 3 million and have the wealth creation alongside of also retaining these RSUs, because I know that's an important probably part of everybody's strategy is how do we retain as much as possible.
I want to address the question that comes up first in almost every conversation I have with Broadcom employees. Where does the money come from to get started? Getting into this strategy, everything included, the down payment, furnishing, setup, start to finish is $200K. That's the number. That $200K is almost certainly already sitting in your brokerage account. Every quarter, when your RSUs vest, Broadcom sells a portion of your shares to cover tax withholding. What remains after that lands as cash. For someone vesting at the levels we are talking about, a few quarters of accumulated after-tax cash is typically more than enough to fund this. You're not liquidating your Broadcom position. You are deploying cash that your vest cycle has already generated. and that is sitting idle. And here is what makes this really compelling. And as Randall already showed the numbers on the spreadsheet, after year one, the tax savings and the rental income fund the next property. Then the cycle repeats. You put in 200K once, the strategy builds from there. I have had this conversation with multiple Broadcom people, and the same concerns come up every time in the same order. Let me go through them directly. Number one, complexity. The first thing I hear more than anything else is, this sounds complicated. How do I know I'm doing it right? And that's a fair concern. The strategy has real moving parts. The cost segregation study, finding a cash flowing short-term rental property, the material participation rules. If you are trying to put this together on your own, it would be complicated. That's exactly why we build a framework around it. Before you look at a single property, our CPA sits down with you and discuss your specific vest schedule, your income, your state, and maps out exactly what the tax strategy needs to generate to give you the maximum benefit. You know the target before you commit to anything. We handle the complexity. Second, I'm already stretched thin at work. I don't have time to manage a vacation rental. Completely fair. And if this required you to become a hands-on Airbnb host, it wouldn't make sense for most Broadcom employees or any high-income tech professional who are already working with us, buying short-term rentals and leveraging the short-term rental loophole. That's not how we built this. During the launch phase, we built the local management team for you. Cleaning, handyman, contractors, everything. All of it is the setup before the property goes live. The material participation requirement is real. It involves involvement of at least 100 hours in the year. Activities like overseeing, setup, managing the team, weekly calls with us, all count toward that. It's doable, and our CPA partners show you exactly how to document it. Once the property is running, most clients spend 1 hour or less a week staying on top of it. Some people that I talk to also mention that they don't have 200K in cash sitting around. This is an honest question, and I want to address this directly. Most Broadcom employees at this compensation level do have this capital. They just haven't thought about where it lives. Every quarter, Broadcom sells a portion of your vested shares to cover tax withholding. The after-tax cash that lands in your brokerage account after each vest across just a few quarters is typically more than enough to cover the 200K. If you're not sure what you have available, that's one of the things we look at together on the strategy call. The last one, why bother with real estate when Broadcom stock is going to perform everything over the next few years? Well, I don't disagree with that thesis. Most people I have talked to inside Broadcom have real conviction in the AI story. I'm not here to challenge that, but the stock going up does not reduce your tax bill, not by $1. Your RSU vest income is taxable whether Broadcom stock doubles or stays flat. The STR strategy and your stock position run in completely separate lanes. You hold your long-term position, you keep all the upside, and separately you put the cash your vest cycle is already generating to work in a way that cuts your tax bill and builds income outside of Broadcom. There is no trade-off here. Here's where we land. If you are a Broadcom or a former VMware employee with total compensation of $1 million or more this year, there's a very good chance you are handing the IRS more than you have to. Not because the law requires it, but because this structure requires specific expertise that most CPAs do not have. And the conversation simply never comes up. The people I spoke with at Broadcom are sharp. They spend years mastering what they do, but expertise in engineering or product doesn't translate into a tax strategy. And nobody in your team meeting is going to bring up what to do with the cash sitting in your brokerage from the last quarter's vest. The starting point is a 30-minute strategy call with our team. We pull up your West schedule, look at your income, look at what you have available to deploy, and tell you exactly what's possible for your situation. No pitch, just the math. The contact form is in the show notes. And you have a colleague or a friend at Broadcom who you know is sitting on a real tax bill and doing nothing about it, send them this episode. Tax strategy is one of those things nobody talks about at work. But after this, you know they probably should. Thanks for listening. We'll see you on the other side.